Hi, we're Group 3. My name is Tian.
My name is Mary Carmen.
And I'm Jason.
And for our stock analysis today, we'll be discussing Lockheed Martin. To give a brief summary, Lockheed Martin started out as Lockheed Corporation by two brothers, Glenn and Alan Lockheed, in 1926. Glenn Lockheed made his first flight attempt in 1907 and was almost killed by a propeller as he tries to start a plane by himself. However, this does not discourage him as he attempted to take flight yet again 2 years later in 1909. This time he was successful and was able to hover above ground by about 100 feet. In 1995, Lockheed Corporation was forced to merge with Martin Marietta due to an economic collapse, creating Lockheed Martin. Currently, Lockheed Martin is the largest provider of IT services, system integration, and training for the U.S. government, which explains why about 80% of Lockheed Martin's revenue comes from the U.S. Defense Department, which includes the Navy, Marine, Coast Guard, Army, and Air Force. In addition, Lockheed Martin also does business with international government and intelligence agencies. Lockheed Martin currently participates in four different segments. First being aeronautics, which is 39.4%. This includes any type of fighter jets such as the F-35 or the SR-71 Blackbird. Second is rotary and mission system, which is 26.6% of revenue. And this allows Lockheed Martin to outfit Humvees and helicopters with weapon and radars. Third is space, which is 18.2% of revenue, and this allows Lockheed Martin to participate in creating space devices such as satellites. On the top right hand corner is the space satellite Orion, which is expected to land on Mars by 2030. And last is missiles and fire control. This allows Lockheed Martin to create any type of missiles, such as cruise missiles for submarines, supersonic missiles for air combat, and currently in development the hypersonic missiles, which is able to outmaneuver and outspeed any type of defense system. In addition, we believe that Lockheed Martin in the near future should be expecting more money from the US government due to the current administration's desire to increase the defense budget. President Trump has created the Space Force, which means more money for the space industry companies such as Lockheed Martin. Lockheed Martin has an alpha of 12.22, which can explain why it is slightly above the market. However, because its beta is 0.97, we can see with any market changes, Lockheed Martin will also take a hit. This can be seen in December of 2018 when the market had a slight drop due to the Bitcoin crash.
Hi, my name is Mary Carmen, and I'll be going over the financial statement and DuPont analysis. So starting off with the income statement, one thing that we noted was that sales have been steadily increasing in the last 5 years, and that is primarily due to an increase in contracts with the U.S. government. Moving on to the balance sheet, investment into property, plant, and equipment also saw a steady growth due to the increase in contracts. Since 2017, liabilities have decreased while equity increased in an effort to shift towards more equity financing. Lastly, the cash flow statement, there was a 52% drop in operating cash flows in 2018, and this was due to a decrease in liabilities and lower inventory turnover. The DuPont analysis calculates ROE through an analysis of leverage, efficiency, and profitability. So starting off with leverage, we noted that Lockheed Martin has a low debt-to-equity ratio when compared to the average of 16.97. And they did this by decreasing their long-term debt, which follows their recent strategy for equity financing. However, they're still safe to finance with debt as their interest coverage ratio and their current ratio above 1 shows that Lockheed is making enough revenue to cover interest payments as well as their short-term debt. Next slide. Moving on to profitability, both the EBIT and EBITDA margins increased in the last 3 years, which means that the company is becoming increasingly more profitable in relation to their operating expenses. Also, according to the CSI market, the industry ROI as well as the industry net income per employee are both well below that of Lockheed's, as shown here, which further solidifies their profitability. Next, moving on to efficiency. Looking at some asset management ratios, we saw that the total asset turnover has increased since 2016 up to 1.29, which is higher than the industry average of 0.8. This shows that Lockheed has been using its assets efficiently to generate their sales. The receivables turnover shows how efficiently the company is at collecting funds. So the increase in this ratio shows that Lockheed has had a higher proportion of customers that quickly pay off their debts. The accounts payable and inventory turnover ratios are also very attractive. So overall, these high ratios enforce the creditworthiness of the company, as well as they indicate a relatively short period of time between purchases of goods and services for those payments. After taking the leverage, profitability, and efficiency into account, we reached an ROE that is significantly higher than the industry standard of 40%, which makes Lockheed Martin a leader in the aerospace and defense industry. So now I'll hand it over to Jason.
Okay, so I'm Jason. I'm going to go over the valuation of the company. But before we can determine whether the stock is properly valued or not, we have to conduct a CAPM analysis to find the cost of equity. And the way we did that was find 5-year historical data and separate it into monthly returns from market return, risk-free return, and Lockheed Martin return. After that, we ran a regression of risk premiums of both market and Lockheed Martin risk premiums to find both alpha and beta of our stock. And as you can see, the intercept is 0.01%, and our beta is 0.9657 or 0.97. And here are the regression results and expected return calculation. The beta was taken from the second coefficient of the regression, while the alpha was taken from the intercept of the regression result. Expected market return, risk-free return were all calculated via average of all monthly returns and multiplied by 12 to make it annual. And then the first LMT return was computed via the CAPM model plus alpha. And then this actual LMT return was computed from average of historical returns. And as you can see, there was no large disparity between the two, making it seem very accurate. And right here, you can see Lockheed Martin versus the market. As you can see, as Tian said before, LMT is a lot more volatile than the market over the past 5 years. The primary cause of such disparity is largely due to the high alpha of LMT, as mentioned before, as expected return without alpha is less than the market return. And right here, you can see the SML line, which displays the relationship between risk or beta and expected return. And because the SML line of LMT is above the SML line, you can say that the LMT is undervalued. And the SCL, which compares the company to the market, it shows the trend of company return expecting to exceed risk-free return, as most points lie above the SCL line. For the free cash flow to the firm model, most projections were attained via the value line report, with the exception of the price-to-earnings ratio of 2020 from Yahoo Finance. The terminal growth rate of 4% was used because of industry's relationship with the U.S. economy, as historical GDP growth rate is 4%. The first year of the transitional stage was the average of previous 3 years' growth rates for 2025. And then increasing depreciation is most likely due to more aircrafts and projects being started, and price to earnings is increasing due to the expected earnings of the company to be increased. So after all of that, we find free cash flow to the firm by getting profits after tax plus interest plus depreciation minus increase in net working capital and minus capital spending. After that, we can find the terminal value by finding the next year's free cash flow and dividing it by the WACC minus the terminal growth rate. To find the weighted average cost of capital, we have to have tax rate, cost of equity, cost of debt, and the weight of each debt and equity. The tax rate was taken from the Tax Cuts and Jobs Act of 2017, and the cost of equity was from the CAPM model. But we used an average beta between the value line and the CAPM analysis. And the cost of debt was found from the Moody's seasoned AAA corporate bond yield, and the weights were determined from the debt divided by the debt plus equity, and 1 minus the weight of debt. After that, we can finally discount all our free cash flow and terminal value to the present value, and then we add them all up to find the intrinsic value of our stock. And after that, we can find our equity value by subtracting debt value. And then to find intrinsic value per share, we divided equity value divided by shares outstanding. To wrap it up, we have a few conclusions and recommendations for potential investors. First of all, both security market line and free cash flow to the firm valuation model point to the stock being undervalued, as intrinsic value per share is $593.71, and the current stock price as of today is $376.54. We recommend to buy and hold for a long-term investment, as disparity is extremely large. Beta is also less than the market, meaning it's less risky, and alpha or excess returns is extremely high. Although current market conditions are uncertain due to a pandemic happening, we believe the market will bounce back. Also, currency may be debased because a lot of government bailouts may happen, leading to citizens buying hard assets or stocks, which may lead to price rising as people are buying more and more stocks. Thank you for listening, and that's going to wrap it up for our report on Lockheed Martin.